Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings Monthly Conference Call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, press *0. I would now like to turn the meeting over to Ms. Kayla Peacock. Please go ahead, Ms. Peacock.
Thank you, operator. Welcome to the Barometer Readings Monthly Conference Call, our regular forum to share our market insights and review the most current portfolio positioning. Joining us, as always, is David Burrows, President and Chief Investment Strategist. Also joining us today is Jimmy Brennan, Head of Fixed Income Trading and Co-Portfolio Manager of our Balanced Mandate. 2015 has certainly proven to be an eventful year so far, and so without further ado, I will turn the call over to Dave to share his insights.
Hey, folks. I hope everyone's doing well. Welcome to another new year. It's funny how everybody's interested to know what's up for 2015, what's changed, how are we going to be doing things differently. And at the end of the day, probably the biggest message is largely what was going on at the end of last year starts this year and carries on. As you know, we think that we have three basic jobs. One is to use the tools that we have to kind of find the pockets of the market that are seeing net new inflows of capital. Where is the market leadership? And focus our portfolios in those areas. The second job, which is probably a little trickier, is to recognize change, new leadership when it starts to emerge, and old leadership when it starts to fade, so we can transition our holdings, which means that from time to time we have to go through fairly significant repositionings. And the third thing is, in the absence of leadership, we have to have an ability to play defense so we can ultimately give our clients what they're looking for, which is a return with a risk characteristic they can live with. So I think we come into this year with some fairly clear themes that have been in place for some time. There are clearly changes taking place. There's a lot of noise and news that people have been sifting through, trying to figure out the implications. And so I'm going to take a cut at it. But I think, as you know, we believe that we entered a secular bull market for equities, and specifically developed consumer-led markets in 2012, around the time correlation started to fall market to market and sector to sector. And that since then, we've seen a pretty steady progression of growing earnings and improving multiples. So rising multiple and growing earnings gives you geometric lift in prices. I think people have had a hard time figuring out how it is that markets have been going up more than earnings have been. Well, that's multiple expansion. And we know that historically when that begins, it goes on for a long time. So as we come into this year, forget about the news, forget about the noise. What is happening? Breadth in equities globally is expanding. That very simply means money is finding its way into stocks. If we break it out geographically, there's have and have-nots. The U.S. has been the deepest, most resilient market over the last 3 years and continues to be the case. Virtually no wobble over the last few weeks as people second-guessed the longevity of this bull market. Canadian breadth started deteriorating in the fall of last year, August, September, and continues to do so. So that tells us that we should be focusing our attention on the U.S. market. And as you follow our holdings, you've seen that very steadily our U.S. equity exposure has steadily been rising. Our Canadian exposure has been falling. If we look around the world at all the various markets, second observation I'd make is that in general, breadth is expanding in consumer-led developed economies. And there is generally weakness or underperformance in emerging markets, developing markets, and the countries that are supplying developing markets, which probably includes Canada. So it means consumer-led economies where we're focused. Now, breadth in Europe has actually been expanding nicely. Of course, the problem is the euro's been getting crushed, so that sort of takes Europe off the table for us. If we look at GDP growth in the U.S., it's been getting generally better. GDP growth in emerging markets is weakening. If you look at price performance in the indices themselves, emerging market indices have been underperforming U.S. and continue to. Investment grade and high yield debt in emerging markets has been underperforming. I think clearly there is concern about the strength of the dollar and the cost that they have to incur to pay their debt that's denominated in dollars. But the one clear theme that I would say is that U.S. is on a path of outperformance versus emerging markets, and that shows no sign of abating. We're about 3 years in. This can go on for 10 years. U.S. dollar, which was so strong all the way through the 90s as people bought U.S. stocks to take advantage of the boom in technology, weakened from 2000 to 2012 versus the basket of world currencies as people rotated away to other asset classes and themes. And as you know, we believe our job is to find our way to the themes that are seeing new net dollars getting put to work. In the last 2 years, U.S. dollar has firmed up nicely. I believe has begun a move that will go on for some time. It's hard to see how euro is going to be much stronger given what's going on with the ECB. It's hard to see how the yen's going to be much stronger, what's going on in the Japanese central bank. And so we know there's a very high correlation, strong currency, strong stocks. Same way all the way through the 80s and 90s, strong dollar, strong stocks. You know, on the other side of the coin in the 70s and 2000s, sideways markets and down currency. So we are seeing rising multiples and rising earnings. We're seeing breadth expanding in the U.S. The most resilient market from a breadth perspective is the U.S. So we're focusing on equities. We're focusing on U.S. From a currency perspective, our currency models continue to show additional weakness for the Canadian dollar. Clearly, weak commodities not good for the Canadian dollar. Weak growth not good for the Canadian dollar. So we're unhedged on our currency. Whereas the driver for the move in the market in the 90s was technology, we continue to believe that the driver in this bull market is energy. And that doesn't show any sign of changing. Of course, we had to change gears partway through last year. The first leg of this move was felt positively by the producers and the service companies and the infrastructure companies supplying into the energy industry. We got to that famous tipping point last fall where we started, whether it was that wasn't enough demand or there was too much supply, price started to fall. Our breadth models turned negative on energy producers and service companies. And I think if you followed very steadily all through the fall, our exposure to the energy industry as a whole was depleted. And we got to a point where today we're basically a single-digit energy exposure, partly refining, partly infrastructure, but it is a very small piece of the portfolio today. On the other hand, falling energy prices is very stimulative to a few sectors. And where we are seeing very strong improvement is specifically this consumer in the U.S., which makes up 72% of the U.S. economy. It might make sense why the U.S. market is doing so well. That is driving the logistics companies like FedEx. It's driving the retailers like Home Depot and Target and Walmart. There's some very clear winners. Home builders are starting to see some real strength in the U.S. Home prices are firming and unit volumes are moving higher. Travel and leisure, which would include things like Disney and the cruise lines. Technology continues to have a very strong bid. Clearly, corporations have lots of cash that they are spending on productivity. Financials, specifically in the U.S., and we've been showing a chart that shows just how badly Canadian financials are underperforming. We went through quite a significant rotation late last year out of Canadian financials. And, of course, one of the biggest weights that we have is in healthcare, and that's been the case for about 2 years. So there are some very clear themes. And you look at a day like today, good rally, very good strength across all those sectors. So these sectors are doing what they should do on a strong day. They also have held up much better through the decline early in the year. So there's very clear leadership there, and there's some great positions I think that we have. Dividend growth has been really strong. Last year's dividend growth in the income portfolio just north of 20%. Now, there's also some have-nots. You know, Canada looks like a have-not. Commodities look like they've reversed their move from 2000 to 2012. We are clearly on the downslope. I have no idea where the bottom is in energy. I have no idea where the bottom is in the rest of the commodities. But if you look at any of the continuous commodities indices, they show a relentless decline, which means that in the state that we're in, Canadian dollar probably continues to move lower. High-yield debt has been backing up. Spreads have been widening. A lot of it has to do with what's been going on in the energy high-yield market, which means that we've not been there. It doesn't mean we're not looking. We're looking for opportunity in energy high-yield. We're not there yet. And sovereign debt around the world is trading at exceedingly low levels. Probably not a lot of upside for us. But it does, if you look at it from a global investor's perspective, U.S. Treasuries do continue to look very attractive at their relative yields. So we think we still see money work its way into U.S. dollars to buy Treasuries. So push comes to shove, the return on capital and the earnings yield of stocks way exceeds the yield of a 10-year bond. We're getting paid exceedingly well to take risk. Breadth models are very supportive. Earnings so far this quarter have been strong, up about 80% on average, beating expectation. Dividend payouts are rising, but they're still below 35%, way below the long-run average of 50%. So if we look at it at the portfolio level, the high-income pool is almost exclusively equities, dividend growth focused. Sector exposures include financials, transports, technology, consumer discretionary, and healthcare. We are now about 60% U.S. dollar weighted. Dividend growth shows no sign of abating. Cash positions are really high in corporations, and we think dividend growth will be very strong again this year. In the equity strategies, clearly we don't have the same yield expectation, so we have more technology and more consumer discretionary in the portfolio. It is more focused in the U.S., about 65% USD, again unhedged. ETF portfolio, highly focused in the U.S., has been short commodities and emerging markets. It's had a real lift over the last 6 months. Seems positioned quite well coming into this year. So we're really happy with the way these portfolios are set up. We see that it is very early days, money slowly working its way out of fixed income into equities. We think that that will be one source of buyer. We think that also there are buyers that are sitting in cash today that have been hoping for a correction that they just don't seem to get. So they are buyers. We think that corporations are buyers of their own shares. And central banks around the world are doing everything they can do to push money into risky assets. So given the fact that you could buy a 5-year bond in Europe or in Japan and get a negative yield, they're looking for other sources which would help explain what's going on with REITs and what's going on with other yield-driven equities. So we're coming into this year, we are quite bullish. We think this year is going to be quite good. We have consistently said that we think we're in a long-term bull market for equities, specifically consumer-led developed economies. We think multiples are likely to expand again this year. Earnings growth should be fairly steady with last year. So we're positioned for it, and I think we're off to the start of a good year. So I want to bring Jimmy onto the call. As I think most of you know, our high-income mandate has been a very popular mandate. A lot of advisors, hold significant amounts. We know there's a bull market in compliance, and we have some clients out there who need to have a fixed income component. So we wanted to bring a prospectus version of our strategy that would include a fixed income component, which we could manage tactically, and because of relatively small size, pick and choose our spots and find some interesting bonds to put in the portfolio. This energy move may set up an opportunity, but I'm going to hand it over to Jimmy and get him to talk a little bit about the new fund. We really appreciate all of the support you guys give us, and hopefully this product might be useful to you. So I'm going to pass it over to Jim. He's going to talk about what he's doing in the portfolio and why you might want to take a look at it. And aside from that, I want to thank you, and we'll look forward to catching up through the course of the year. Jimmy?
Hi there. Thank you, David. Try not to take too much of your time. Appreciate you hanging on the line here. We did have a pool last year. I came in late 2013. I've been a fixed income geek or in the fixed income space since the late 80s. I started at Nesbitt out of grad school. I worked for Solomon in New York and JP Morgan. And always fixed income, always credit, and trying to understand macro movements and what's going on with the central banks and whatnot. So I came in late 2013. I co-ran the balanced fund, or balanced pool, with Paul Campbell, and the commitment was to have a minimum of 25% fixed income. That can be anywhere. It can be from CCC to AAA, or bills to 30 years, and depending on what we see, we can go to all cash similarly. And given, as Dave explained, our models show us we want to be in the equity markets, we've had relatively light fixed income exposure through 14, and it ran between 25 and 30%. What you really get with the fixed income is a dampened volatility. We came through the year with a volatility number of about 0.54, so just slightly more than half of the market volatility. We happen to have a good year and the numbers were good. But what I really would like you to think about is the beta or the market vol. So based on 2014 and the interest people had in the fixed income exposure, we've launched a pool and for now, and it will mirror the same things that we're doing in the balanced fund, except it will have a distribution. So it'll pay out 3%. It'll be a monthly payout, and it'll have a minimum 25% fixed income. Today, it has about 35% fixed income. It was up to 40 fixed income in cash until a couple of days ago, and we started putting some little more money to work. It's like the DLA model that Dave and Greg and Sal work on here. We look at that. We look at sectors that look good, and then once you identify the sectors, then if Dave says we need to be in transports and they pick CN and CP, Paul and I might have picked Union Pacific. We like the strong dollar story. We unfortunately like the weak CAD story, or resonates with us, and so we figure there's a way to get a little extra movement from that. I'll talk a little bit about the fixed income stuff in there, and we have some long U.S. Treasuries. Again, while they don't yield a whole lot, right now there's over $4.5 trillion worth of negatively yielding securities in Europe. And so when I offer you a negative return for your money, you can either accept that, or you can say, well, that's not acceptable to me, I'm going to move on. For people who are obliged to stay in fixed income, they move out the curve or they move into other fixed income products. So I think it's reasonable to expect long-dated European bonds to yield less, to flatten. And when you look around, you say U.S. Raw yields are so significantly greater that the U.S. will continue to do well. Accordingly, we've owned some long U.S. Treasury paper so far this year. It started late last year, and it'll continue to do well. I don't think, given what the EU or the ECB is going to do, that yields can back up a whole lot right now. Certainly, they're going to create a lot of paper, a lot more money, which ultimately may prove to be inflationary, but they're going to buy $60 billion or 60 billion euros worth of bonds over the next 17 months, and then based on what kind of traction they're getting in the economy, they may or may not continue. That's going to take an awful lot of paper out of the space, and for people who are forced into, again, fixed income or European fixed income, it's going to drive yields lower out there, and it's going to drive people to the U.S., to Canada, and other places. So I think yields will stay low, and accordingly, if you think about fixed income, not so much as just the coupon, but the total return. A bond can go from 100 to 105, and with a 4% coupon, you end up getting 9% because of the price appreciation. And I think that's the kind of behavior we'll see unfold. And, as Dave says, we're going to listen to the market, we're going to look, and the market's telling us that this deflation story is a dominant theme. And when you look at what we have in the balanced pool and fund, I don't see my job as trying to predict what the future is going to look like and build a portfolio to match that and then wait for the world to recognize my genius. Our job is to listen to the market and see what the market's telling us, and then anticipate that there might be 4 or 5 different outcomes in the economy, and we need to prepare a portfolio to survive through that and hopefully thrive through that. So you'll see, I think year to date, this portfolio has a beta of 0.51. So we've experienced half the market volatility, and the market's been tough for the first 3 weeks. That's been okay for us. We've managed to stay on the right side of the decimal point because we have had the fixed income, and so sometimes it'll feel like a drag, but in these environments, it'll feel like ballast and actually perform quite well. Specifically to these U.S.-centric type trades, we bought some province of BC bonds, 2-year piece of paper, a 2.85 coupon, which is pretty good, but it was denominated in Chinese yuan, and fairly unique. The yuan is pegged to the U.S. dollar, so it's stuck in a band, and if you believe the Canadian dollar was going to go down, then I thought, well, this gives us great diversification in the portfolio. It also is a great credit, province of BC, and the currency, the yuan CAD dollar currency has moved over 5%. So to date, we're up almost 8% on this piece of paper on something that's going to mature in November of 16. So we'll try and find opportunities like that. Other things, we have some long U.S. Treasuries I mentioned. We have some corporate debt, some high yield or some investment grade, but we look for things that are very well capitalized. I look for strong covenants, negative pledges, senior secured. We have some Air Canada debt that's U.S. pay, again, consistent with that. It's a secured piece of paper, first lien. So it ticks a few boxes, both in terms of what Barometer sees as the opportunity set and in terms of my risk aversion. We have some debt that has a coupon that pays 8 1/8, and the company generates $42 million a quarter in revenue, and it needs $2 million of that to make the coupon payment for the debt. These are the direct cash bonds. It's an 8 1/8 coupon. The common was yielding 9 at the time. At 8 1/8 with that kind of coverage, 20 times coverage for the coupon, I said to Paul and the people here, I said, I'd rather have this bird in the hand than the two in the bush. Now, the stock has done well, and I don't begrudge anyone, but that's beyond my pay grade, as it were. I'm looking to buy safe things here that I think can mature. And in a lot of instances, this paper gets called away. We have some TD North Group. They bought North Group in the U.S., and North Group had issued a preferred 6 3/8, and when TD bought it, they took it over, so it's a TD piece of paper, but with a 6 3/8 coupon. TD will call it as soon as they can, because they can issue at less than 2% right now. But I'll clip that kind of coupon. That'll last for another 3 years. So if we can build a portfolio with fixed income paper like that has either great covenants or strong yield backed up by strong cash flows, and then match up the rest of the portfolio within the same framework that Barometer uses, and then hopefully find slightly different ways to exercise that. I think this is something you might find compelling. Low beta, correlation to high income and equity. Last I looked, the overlap was about 12.9 and 13.9%. So they are different products. I wouldn't suggest one for the other. We're trying to accomplish something very different here. I probably beat it to death for you, but if anyone has any questions, I'd certainly welcome them. Please consider calling your sales coverage marketers or Paul Campbell or myself at any time to talk to any about this in detail. And at this point, I'll open it to questions or say thanks for your time.
At this